speakers, I thank a lot all of you to be here. I also would like to extend my many thanks to MEP Sirpa Pietikäinen from Finland, and without her and your help also, we wouldn't have been able to organize this type of event. Just one word to say how important it is for Aéma Groupe to share the organization of such an event. You know, or you do not know yet, that we are a big French mutualist insurance group. We cover 12 million people in Europe throughout all the types of insurance, including savings, of course, and we'll talk a lot about this. We're also a big asset manager, managing 200 billion euros in Europe with a strong ESG perspective. So I believe we will speak about that in our two panels. So we are thrilled and very happy to share here in Brussels, where the regulation is being made, the prospects on all the things that are happening on savings investment stuff here in Europe. I won't say many more words because I have to leave the room to someone very important for this event. So the MEP Sirpa Pietikäinen, and I invite you to welcome her with your warmest applause. Thank you.
Wholeheartedly welcome on my behalf also, and thank you for giving me the opportunity to co-host this event that is, from various points of view, very interesting and important. Firstly, the truth and the facts, the mathematics and biology doesn't listen politicians, be it Trump or someone else. And you all know that the climate change is speeding, and the speeding is speeding. That is actually very worrisome. And we are going to have, even we would stop breathing, the 2 degrees globally at some point in 2030. In insurance perspective, this is tomorrow. And we all know the risks that it causes to reinsurance. And we all know that we need a urgent investment in green transition, in long-term investments in our energy infrastructure, in energy efficiency, in circular economy, and we like go on. Well, then how to do about it? Firstly, you can't do everything like what is needed with the public money. You can, of course, take part of it and give a bit of a boost with the public money. But the majority needs to come from the private sector. That's why we would need the sustainable finance all in all. That means company reporting so that you know who are doing and what and who are actually more climate or biodiversity friendly. You need credit ratings in the longer run, both the member states and the companies. You need public procurement to acknowledge and prefer environmentally better and socially better solutions. And you need to take that into account, like the ECB is doing, on your risk assessment and so forth. And then we need insurance companies. Insurance, by definition, understands and can calculate what the risk is. And I don't know many better actors in the society on risk calculation, and so we could benefit it much more. And the insurance companies are a huge beholder of funds, especially pension funds. The question is, how can we use these funds for long-term investments in the way that secures the green transition and secures our pensions? Well, there's a trick or two that needs to happen in regulation, but I don't go there because this is the whole topic, to hear you and the panels about the subject. But I think that the role of insurers in general should be much stronger when we talk about savings and investment union. And especially, and this is a dear part to me, for a resilient economy we need different kind of actors, big companies, international companies, micro companies, and SMEs. But we need cooperatives and mutuals because they are stable, they are much more reliable, less risky in the longer run, and they bear much bigger responsibility on not wasting our money, especially when it goes in our pensions. So personally, I have trusted with my pensions the mutual company, no wonder that I've done it. So very happy to be here and to see how we can marry the risk assessment capabilities, the mutuals, insurance, and savings and investments union. Wholeheartedly welcome.
And now I call, I believe it's Cornelia, holding, no? Who's taking the first? Oh, sorry. So be welcome and be applauded.
Okay. Thank you very much, and welcome everyone. Is this working? Yes. Well, if not, I'll shout. So let me introduce the panelists for this first panel, and let me start with Clara Adissam, who's the Director of Life Strategy at Abeille Assurance, where she shapes the implementation of long-term strategic initiatives. So please come up. Then Mark Horowitz, who's the Deputy Head of Unit at DG FISMA T4, has been at the European Commission since 2018, and before that spent some time at the ACPR. Julia Simon, Head of Research and Advocacy at Finance Watch, has been so since January 2022. And of course, last but not least, Dr. Lucio Vinas de Sousa, who's the Chief Economist and Director of the ECOFIN Department of Business Europe. So, thank you very much, all of you, for accepting to take part in this panel today. So, the SIU is obviously a big umbrella term today for a number of initiatives at the Commission, and we'll try to put a bit of structure around this very wide topic. So, what we propose is to divide our discussion, I think, in three blocks. First, understand what the SIU is in relation to, in general, the role of insurance. Then have a look a little bit at the role of insurers as institutional investors and how that fits in with the SIU objectives. And then finally look at the role of insurers as product manufacturers and distributors of insurance products. So with that, maybe let me first turn my attention to Mark. Maybe if you can help us set the scene a little bit. Obviously, the Commission announced the new SIU strategy in March 2025. It doesn't come out of nowhere. There's a lot of history that happened before the SIU. So can you tell us a little bit from the Commission perspective what the core objectives of the SIU are and the key actions when it comes to insurers?
Does it work? Yes. So first of all, thanks for having me today. Good afternoon, everyone. I would say that from the Commission's perspective, the core objective of the Savings and Investments Union is quite straightforward. We want to ensure that Europe's substantial savings are better channeled into productive investment opportunities, supporting growth, innovation, and economic resilience, as you were saying. Today, our assessment is that too much household wealth is concentrated in low-yield deposits, while at the same time, Europe's needs has significant investment needs to finance digital transformation, innovation, or the scale of financing. the SIU is really about closing this gap. It is not a capital markets, because you were saying that there is a history indeed, but it's not a capital markets project in the narrow sense. It is a broader strategy to improve citizens' financial outcome, improve access to finances for businesses, and therefore to enhance Europe's competitiveness. And in that sense, the shift from capital markets union to savings and investment union is not just a marketing exercise. It's a clear refocusing. We want to put citizens first, and then, of course, long-term financial outcomes for citizens as the key objective of our initiatives. And in this context, insurers can play a key role because they play on the two sides of the equation, I would say. First of all, they are long-term investors. They have a lot of assets to invest, and therefore they are very able to make financing, to create financing opportunities in infrastructure, in private markets, and in equity. But also they are key providers of retail products for citizens, be it insurance products or pensions products. So, of course, your question was already framing my answer. So I would say that indeed we cannot separate the two elements of the contribution of insurers. Insurers are the central intermediation or interface between, on the one hand, households, savings, and on the other hand, Europe's investment needs. And this is the heart of the SIU. And in terms of priorities, or at least key actions, I would say, I will not go into the details, but of course, the key initiative for the insurance sector is Solvency II, with the objective of boosting or improving investment capacity by insurance companies. But prudential rules alone are not enough. So what we need is, what we have done actually is a series of initiatives which are mutually reinforcing to support insurers' investment capacity. It includes securitization to also facilitate more loans to the real economy. This includes a pensions package to improve and strengthen long-term savings, and market, and more recently, market integration and supervision to reduce fragmentation and promote more cross-border capital allocation. So together, these measures aim to provide the right incentives and the right opportunities for insurers to better invest at scale. On the retail side, in addition, we want greater participation of retail participation in capital markets with simple and trustworthy products. But participation is not an objective in itself. What we want with better participation is also better outcomes, better long-term financial outcomes for citizens based on trust, suitability, and therefore value creation. So in a nutshell, with the SIU, what we note is that Europe doesn't lack savings. But what we need is a system that transforms those savings into long-term prosperity. And insurers are a key player for that.
Thank you very much, Mark. And maybe looking at you, Luso, representing the wider private sector, I think, so Mark mentioned the need to move savings into productive investment. You sit on the other side, receiving essentially the investment money. So from your perspective, are European capital markets currently structured in a way that effectively finances productive investment, and is the current regulatory framework designed to allocate sufficient capital to risky assets?
Many thanks for the question and for the invitation. I can only reply to your question, which was not a leading question at all on the negative. Right? So now let's start in terms of the overall financing needs of the European economy. It's obviously clear that we have a significant amount of savings in the EU over and above other regions of the world, for instance, the United States. But the question is a supply and demand identity, right? So you have to have uses in terms of the European Union that would justify the mobilization of those resources for domestic types of investments. And when you look, and we did actually surveys in our members in relation to that, you do actually observe right now a significant investment gap. So there is, on the demand side, areas in which we can productively use this amount of savings in the European Union. At the current levels, if you put on the top of that what we are talking in terms of the strategic objectives of the EU and taking them at face value on all sorts of areas, including defense, we are talking about an investment gap that is certainly on the level of several trillions of euros. Now, where this money is going to come from? Our financial system is currently designed that, given the preference that our regulators have for financial sustainability, which obviously is important, but financial sustainability should be there for growth. The best type of assurance that you have for a sustainable and safe financial system is obviously economic growth. If you don't have that, ultimately your financial system is not going to work. Our financial system is essentially bank-centric. Roughly 80% of the financing needs of our companies come from banks, so banks have to be part of the equation. Now, we just sent our reply to the consultation, or the target consultation, if you prefer me to use those terms, in terms of what we think is going to be necessary there. There are regulatory tweaks, which we think can liberate several hundreds of billions of euros in terms of capital, which is currently frozen, and probably unlock a few trillions of euros of financing just on the banking side. But beyond banking, we need the other components of our financial system, and of course, insurance is one of the key ones in relation to that. We are therefore extremely supportive of the changes that you have in terms of the Solvency II as another way for you to unlock capitals of this other component of our financial system. We need all sorts of capitals, right? We need long-term risk capital. We need capital that will be the traditional banking capital, and those are not separate areas. The financial system is an ecosystem, right? So one affects the other. We need also a change in terms of the level 2 solvency regulations, which are done by the regulatory agencies, which are, let's put it this way, very active in terms of the structure of the European Union. We also are very supportive in terms of the mobilization of the amounts that we have in terms of the pensions systems in the EU. But bearing in mind the responsibilities that we have at the level of the individual member states for social partners to define the way that those occupational pensions are going to be used. We are not talking here about the across-the-board type of obligatory enrollment type of a mandate, because that's something that not only us, but other social partners would be very resistant to. And we are on the record on saying that. Another way for you to try to unlock that would be finally having a implementation of the securitization package, which is another delta there. So, being very brief in terms of your reply, no, we don't have a financial system which is capable of supplying the current level of investments that we need for the European Union, and not the future ones. The delta then would be several trillions of euros to take care of all the stated priorities that we have. To address that, we need an across-the-board work in terms of our financial system, going from banks to other types of players, capital markets, which is something that we just did not mention here. Insurances are part of a mix that should be deep, diversified, and sustainable from the point of view of the European economy. Thanks.
Thank you very much, Lucio. So we've heard from Mark what the objectives from the Commission side are with the SIU. From Lucio, the need for diversity in the funding sources as well for the private sector. Maybe turning to Julia now, maybe giving also the perspective from citizens and Finance Watch. So what are the expectations from your side, from the SIU, and where do you see the role of insurers there?
Thank you, and also thanks from my side for the invitation. So answering from the point of view of citizens, I think it's important to remember that citizens as such have very diverse roles, and there are a lot of different diverse perspectives on citizens. Of course, as an organization representing also consumers, we talk a lot about citizens as users of the financial services. So this can be savers, investors, pension investors, but also citizens in a broader perspective that obviously also have a big interest in flourishing European economy, which a stable financial sector that would support that productive investment, that would also support the needs in the long term of the European economy. So as much as the businesses have that interest, so do the citizens. Now I'll take a little bit to also complement my panelists' perspective of citizens as users of the financial services. So they are investors, they are savers. Again, they expect to have their pensions at some point. Of course, they are interested in having fair, transparent products that fulfill those needs. Products also that truly deliver the value for money for them, products also that they can understand, and products also that really support those long-term objectives, right? That look into what will happen with our society as it's aging, what will happen with our economy as it's being affected by climate change, by other structural changes. So all of those frameworks that we have in place to support those are obviously very, very important. And citizens also have an interest in basic financial services, which are easily understandable, which are accessible to those who are not so financially literate as to understand complex and maybe also more costly, very often, financial products. And when we speak about SAU, we also speak about how about we get possibility to invest in other countries. I do not know if everybody necessarily thinks about those things, but I think that is something that comes to mind as well, as we talk a lot about how the savings of the EU citizens and residents very often go to other markets. So how do we create that virtuous circle in the European Union? And I would also argue that when we discuss these different product options, it's much more than just risk and return considerations. So it's really about the fact, how do we create possibilities to invest in the EU that would in turn come back to us in terms of profits for the companies, better jobs, that would in turn then also increase the possibilities of the same citizens to invest and to save, right? Because only via that would we achieve that. So the things like transparency, good product design rules, clear safeguards, also addressing the inherent short-termism in the financial markets are very essential in that respective. And I think the big elephant, of course, in the room is we also need supportive economic policies that also create predictability, legal certainty for the businesses to make those investment plans that would then attract finance, right? So that is something that I think we will not solve it today here, but I think it's worth mentioning. Coming to the role of insurers, so of course they are providers and designers, manufacturers of those products. At the same time, they are also long-term investors, as has been said already. They are very well placed with their asset liability matching to take that long-term view and invest with that long-term perspective in mind. Of course, this requires very strong stewardship from insurers. This also requires appropriate integration of risks, especially that we talk today about sustainability for our economy in the future. So integration of sustainability-related risks in the framework. Also good transparency towards the citizens, but also towards the governments to create the trust and provide a view on where the money is actually flowing into. And I would stop here and say that I'm sure we can continue on especially on some of those reflections, especially how can we achieve that in the financial system that unfortunately remains rather short-termist than long-termist, and how can we look into those European priorities with the products and types of investments that insurers make. Thank you.
Thanks, Julia. Very interesting comments on short-term, that helps me also give the floor now to Clara, here being a representative of the insurance sector, but also more specifically a mutualist insurer with a specific business model. So can you explain a little bit, maybe from your perspective, what Aéma is already doing to satisfy the objectives set by the European Commission, and the role that you play as a buy and hold investor, very often described?
Thank you for the invitation and the question. And I want to thank the other panelists for recognizing the role of insurers in this SIU strategy, because in the recent debate, I heard many times that life insurance is not considered as a long-term investment. Some people may say that as people who invest in life insurance can withdraw their savings from life insurance, they consider it not long-term investments. But however, as life insurance, as you said, we encourage long-term investments, and we manage. It's very important. We manage the investments for our policyholders with a strong focus sometimes on capital preservation. For instance, in France, we have a very specific kind of funds, which is called the Fonds Euro, and put your savings in this fund, and at the end you are sure that you will not lose money. And this kind of fund and this kind of diversification, we manage the diversification. We invest in private equity, and we can also enable savers to invest in more risky products, which is called a unit of account. But the liability structure of our life insurance contract allows us to stay invested through cycles and to avoid pro-cycle sellings. For instance, we are not trading, and the role of the insurance is to ensure that we are not afraid of the market going down or up. We are managing this kind of risk. And it's very important because in Europe and considering the European sovereignty, it's a necessity in order to make European champions in Europe. And if I take the example of France before talking about Aéma Groupe and our insurance companies, life insurance represents a major share of household savings, and a very majority of it is invested in Europe. For instance, I work for one of the companies of Aéma Groupe, which is called Assurance. And we insure one of the France's largest saving association, which is called Affaires. And in this famous Fonds Euro, we are managing 40 billion euros. And almost 80% of this are invested in government and corporate bonds. What it means is that we are investing in energy, infrastructures, schools, hospitals, green transition, digital transition, and to some extent, even defense, if needed. And in 2024, Assurance had more than 7 billion euros invested in sustainable assets. And we managed to reduce our carbon intensity of corporate bonds by more than 50% since 2019. So we are very proud of our trajectory, and we are willing to improve this trajectory. So yes, we can play a role through the funds that are managed and through unit-linked accounts, and we have many unit-linked accounts which are linked to digital transition or green transition through private equity.
Thank you very much, Clara. So now focusing a little bit on the role of insurers as institutional investors, I think the latest data we have on the amount of money being managed by insurers is very often, the number that's thrown around is that we're managing 9.5 trillion euros. Obviously, the insurers manage this money with a number of constraints and factors they have to take into account. One of them, I think, Mark, you already mentioned Solvency II, but there are naturally other factors that come into consideration. So, Mark, could you maybe tell us a bit more, maybe a few words about what you tried or what the Commission's objective was with the Solvency II changes that were made, but also what is the Commission doing beyond changing prudential rules to encourage investments into those, say, more productive assets?
So as a confidence, when we prepared this panel, because Philippe knows that if I'm asked a question about Solvency II, I could speak for hours. And I see that there are other Solvency II junkies in the room, but I commit that I will stick to a few minutes only. No, we indeed consider that the Solvency II review has been a clear achievement in terms of supporting insurers' investment capacity. This, I would say, translates in different ways. First, we call it improve investment abilities by reducing the overall level of prudence of the framework, not to the detriment of policyholders, but we have reduced, I would say, the margins of conservatism. And we have released several tens of billion euros of capital which could be invested in more in the real economy. And because of the leverage effect, you need to multiply by 4, actually, in terms of how much it could translate in terms of long-term equity investments. So I have read, for instance, S&P said that sometime that the review would release 80 billion euros of capital. I'm not committing on any figure myself, but if you trust the S&P figures, 80 billion euros means more than 300 billion euros of ability to invest more in long-term equity. I would also pitch another initiative, another element which maybe came as a surprise for the sector, but which is important politically, which is what we called, it's a bit of a jargon, bureaucratic, long-term investment on the legislative programs. So the idea is really to say, like for the EIB or EIF, so which has developed fund-of-fund structure, the ETCI, the European Tech Initiative, for instance, Champion Tech Initiative. The idea is to say if there is an involvement of the public sector in the form of a guarantee, subsidy, or significant co-investment, then the framework should recognize the risk-reducing effect of the public sector, and as such encourage more investments in private equity and venture capital, where, despite already the massive amount invested, we believe that insurers can do a bit more. This is a matter of competitiveness and of strategic autonomy, because private equity and venture capital are more directly related to the EU innovative companies. I would also mention briefly, because it was raised, we believe as part of the securitization package that we have done quite a lot in terms of reducing the obstacles to investments in what we call non-simple, transparent, and standardized securitization, with capital relief of up to 80% depending on the rating. And we know that these non-STS securitizations are often invested in companies, in businesses. It's financing the businesses. And as such, we believe that on securitization, we have also made quite a substantial effort, which is complemented by the ongoing negotiations on securitization regulation and CRR. But then you ask me a more tricky question about what comes more for the Commission. And there, I would first say we need to deliver on our full action plan on the Savings and Investment Union. And in relation to insurers, I would say a bit provocatively, the Commission has done its job. And now it's your turn, insurers, to do yours. We have released investment capacities. We have framed the framework in a manner that it's more conducive to long-term investments. But we want to see the investments, or more investment than currently, in the real economy, in private markets. And this is why, as part of the review, we insisted that there should be a monitoring aspect. We don't want to increase administrative burden, but it's important that EIOPA reports transparently to Commission, to the co-legislators, whether the review delivers in terms of actual further investing in the real economy, instead of doing something else. Mutual companies, for instance, cannot distribute dividends. So, of course, the money is aimed to finance the real economy, and we want to see whether this is successful in this regard. In a bit further term, we have, of course, already, and it's almost tomorrow, the first review of the Solvency II framework again in 2030 as part of the ongoing review of the calibrations of the capital requirements. This will take into account the evidence. This will also take into account how the framework, as it stands following the review, has improved or not the investment capacity and the behaviors of insurers in financing the real economy. And as you said, beyond prudential rules, we need to deliver on the other fronts, so on the Savings and Investment Union, on the market integration, because in order for insurers to provide more long-term investments, you need the availability of investable assets, and you need deep capital markets in Europe. And that's very important, and that's what we try to do with the ongoing legislations. And finally, an element of reflection for the sector. You know that we are working towards the end of the year on the integrating European framework for climate resilience. And I think it's important to bear in mind that an economy can only be resilient if it's resilient also against natural catastrophes. And there, insurers, because they are risk carriers, because they can finance, as you were explaining, the green transition, are key players. And I think that whatever is done in the context of this framework, in any case, within the insurance sector, there needs to be a reflection on how you can ramp up your contribution to closing the natural protection gap.
Thank you very much, Mark. Maybe turning to you, Clara, you heard Mark. The Commission has done its job. They've changed the prudential framework for insurers. Any reaction to this, but also looking again beyond prudential requirement, what other obstacles remain for insurers in constraining their ability to invest in equity and long-term assets?
Thank you, Mark, and thank you to the European Commission for all the work done on Solvency II. And I will be glad to talk about Solvency II because it's a subject that matters to me. Thank you. You have done your part, of course, and we still do ours. But I want to focus on the fact that you were talking about small companies and the fact that investing in private equity is a necessity to improve and to make the SIS strategy a success. But the investment capacity by working on Solvency II, sorry, but it's not enough because I will explain why. We are facing today a challenge, us insurers, because of the lack of liquidity of this kind of assets. And for life insurance, as we told you before, the life insurance is you can withdraw your money at any time without, for instance, for the €4, without losing money. Of course, it's not the case on the unit-linked asset, but in France, we are facing this kind of challenge. So, I think we might together. It might be a good solution to work on the liquidity management constraints. And at Aéma and with the public affairs of Aéma, we already talked about this fact with public authorities, and especially to identify what are the levers and what solutions we can find for sharing the liquidity risk beyond a certain threshold. And we talk about that with the French or European public investment banks. So this is discussions that we will carry on. So this is one kind of solution that we can, in the short term, implement. But there's an opportunity as well, which is technology. And by technology, I mean the tokenization of our assets. And what does it mean? It means that for private equity or illiquid assets, we can divide these assets to make it more accessible, to reduce the entrance ticket, but it does not eliminate the underlying economic risk. It requires a robust governance and custody and investors protection frameworks. But I mean, in the long term, it can be an opportunity for us to deblock this kind of limits. And the second point would be working on transparency and understandable documentation, because I think we may all agree that when we when we read all the papers, PRIPS, for example, it's very heavy. It's not even for literate people and financial, it's still complicated. So we can improve our documentation and make it very transparent and visible for the people to understand that if they invest in this kind of assets, maybe they will not be able to withdraw anytime they want, but they will understand the advantages on the long term. And our role is to give them the visibility every time we send them a reporting to see the impact that the investment is doing.
Thanks, Clara. That was very clear. And I think you're not the only one with the keen interest for prudential regulation and capital charges. And I think, Julia, you also worked on it at Finance Watch. Also looking at the title of this panel, which covers sovereignty, but also transitions. How do you see that we can better steer capital towards not only productive capital, but sustainable activities, and what role can regulation play here from your perspective?
Thank you. So coming back to my previous statement, right, about short and long-termism, I think in the current system as we are, where we know that a lot of things that are happening in the market are being driven by 1 year time horizons or the next quarterly earnings, and the fact that this system as such by its nature is not really suitable to fully internalize things like climate change when we're speaking about time horizons which are far more beyond that. This is where the role of regulation can be crucial, because regulation can be done consciously, right, by a conscious choice to understand that if we don't act today, the future will be not very rosy, and so we need to align the actions of different actors. And again, here the predictability, the legal certainty, the sense of direction that regulation can give can be very crucial. And unfortunately, maybe this is something that we have seen less in the past 2 years, especially here in Brussels, in terms of consistency and predictability and no start and stop. But the good news is there are some still things we can do, and which are partially also on the table, especially if I speak about integrating more of sustainability risk considerations into the regulation, and specifically into the insurance regulation. So at the moment, one notable thing that everybody here, I'm sure, knows well, we have the review of the Sustainable Finance Disclosure Regulation, which matters both from the perspective of retail investors in terms of them understanding and having trust of where the money is going, as well as also in some of the insurers, depending, of course, of how they manage their asset portfolios. But this is still a good opportunity to clarify the categories of products that are there, to lend them finally more credibility and more transparency, and make sure that we are not just trying to green everything by labeling it green, but by simply really focusing on how to make it happen, and making those categories more robust, and really filling them with that sense, and also filling them with certain common sense, and not only kind of arbitrary definitions as we very often had now. What we'll have to follow, of course, once SFDR is reviewed, and I'm not going to comment on the direction of travel, is the review of the client sustainability preferences rules, so that they are also well aligned with those categories that will be new as per the new SFDR. Second thing, as that you hinted to in your question, is obviously the outstanding piece, or I would also say a little bit of a rolled back piece of considering long-term climate-related, and not only long-term, by the way, financial risks in the insurance prudential framework. So we still have obviously the outstanding technical advice from EIOPA with respect to pricing in the climate risk, specifically for the fossil fuels, but also we can talk about how that could be extended to other things in the future. So this is something that definitely needs to happen, because we know that everybody manages everything, or financials, by risk-return considerations. So until we have fixed that, we will have the sustainable investments being at a disadvantage. There could be different options, of course. We are also discussing a lot in the banking space now more of the macro-prudential dimension as a systemic risk dimension, which we still do not have so much in the insurance regulation in the EU. There are some ideas of also how that could be done differently. I think if there is a will, there is a way, of course, and we can also discuss technicalities in many different ways. Of course, doing so, as I said, is also necessary to kind of remove the bias that we currently have more towards fossil or other carbon-intensive investments versus sustainable investments. It's also necessary to protect the financial stability and also ensure policyholder protection. And I think also in the context of sustainable, steering the finance to sustainable investments, the measures that are already in Solvency II, such as the long-term investments or infrastructure supporting factors, are obviously necessary. I think they, of course, they should be viewed in the balance between what are the eligibility criteria, what is the practicality of using that versus maintaining governance and risk management requirements along that. What we've definitely found out all these years with discussing, especially the capital perspective, is that sometimes it's very hard to just fix one part if the other parts are not working in sync, right? So you're kind of pricing in something here, but at the other place it doesn't work. So this only reinforces the need for that holistic look at the regulation, at the savings and investment union as well. I'm not going maybe to expand further. There are some things which we could discuss with respect to how prudent person principle works, and also notably the ever-persisting tax incentives for debt versus equity, if we speak about equity investments. Thank you.
No, thank you, Julia. And I mean, granted, we could do a panel for 4 hours talking only about SIU and the various ramifications that we could take, but it's true that we only have about 15 minutes left. But I want to give Lucio the word again and give you the opportunity to react also to one of the comments made by Mark regarding securitization. Obviously, you made the point that currently Europe is too much lending focused or bank focused, and we need to diversify the funding sources, but also unleash a little bit the lending ability of banks. So, any views on what the Commission has proposed, notably on securitization as part of the SIU?
Many thanks. Allow me to start by thanking all the hard work of the Commission, and I say that as a European Commission official on a leave of absence that actually worked on both the Capital Markets Union and the Banking Union under my boss, Jean-Claude Juncker. But I thank you even more for all the work that you are going to be delivering to us in January of next year, when the package coming out of the report actually comes online. Then I think we can go out and have a beer together. Now, in practical terms, and all that I just said is on the level I meant it, every single word. There are clear questions in terms of the way that the legislation was prepared for the banking sector. And we should remember that we did that during the period of the euro area sovereign crisis. I was there when we were doing that, and I was actually there before. I happened to be the former chief economist of Moody's during the period of the euro area crisis. I had the unpleasant function of downgrading several European Union sovereigns, including telling the French Minister of Finance that France was no longer a AAA. He did not take that well. Now, the implication of what I just said is that many things that we did during that particular period in relation to our banking system were arguably necessary, given the circumstances, but they were crisis-driven. The implication of that is that a lot that we did was arguably repetitive and overlapping into each other. I'll give you one practical example, the discussion about capital stacks in relation to our banking system. We have several different layers of capital, which regulatory bodies, of which we have, I think, 68, if I counted them correctly, right? They're related to the financial sector when you count all the member states in the European Union. This, compared to what you have in the United States, we have 7 different levels of capital for banks here, requirement in terms of minimum capital. The US has 4. Japan has 3, right? Many of those components of the capital stack, they are European specific. In terms of Basel III, they only apply to financial institutions in the European Union. That is basically the reason why we have a significant wedge in terms of how much capital we ask our banks in relation to other parts of planet Earth. If you compare this with the Americans, and before anything that was introduced by the SEC 4 weeks ago, it was already 3 percentage points of capital. That's far from being a trivial amount, right? If you compare to other regions of the world, this can be as much as 5 percentage points of capital. Now, if you put this in terms of estimations that show that once you reach about 11 points of regulatory capital from the point of view of a bank, the marginal addition in terms of sustainability for a bank is basically 0. We have several studies that show that. That shows essentially to you that you could optimize the capital stock that we have currently applied for the European Union in a way that does not compromise financial sustainability for the EU. And at the same time, you free an amount of capital to the order of a few hundred billions of euros, which is frozen within companies and between companies, because capital is also not mobile between different member states due to gold plating from our national regulatory bodies, right? If you put this in terms of what this would imply in added financing capability, we are literally talking about several trillions of euros here. So there are intuitive ways in which you could increase the lending capacity of the overall European financial system. We are very heartened by the fact that our regulatory bodies seem to be recognizing that. The ECB itself has opened the discussion about the, let's put it this way, optimization of the capital stack in the European Union. I think that that is a discussion that will only become more pressing as other regions on the world keep on moving on this dimension and we don't. So that is going to be something that I think we really have to work on. If you allow me one small additional point, which is related to the question of market integration in the European Union. I am a fundamentalist of the European single market, perhaps because of my professional background. You only use money if you have a real project to use that money for. That's the logic of a company, right? If we keep on being the limited integrated single market that we are, with essentially a collection of largely national markets, including on areas like defense, thought experiment, we create a perfect savings and investment union. So we mobilize these huge amounts of pools of capital, but we effectively don't have an integrated single market to invest it. What do you think is going to happen? We already export about 300 billion euros to the United States and to other regions of the world on a yearly basis. You do that without doing the complementary part, which is finally doing something about the single market. The only practical result of that is that we're going to be exporting more capital to other parts of the world, including capital which is supposed to be invested for the pensions of our citizens. So I leave that as my final note.
Thanks, Lucio. Also, being mindful of the time, we still have the third part of the discussion that we wanted to touch upon, which is the role of insurers as product manufacturers and product distributors. I want to give the word first to Julia to explain from a perspective of Finance Watch. I think we often hear some criticism over the insurance-based investment products, notably about cost transparency, value for money. So maybe to kick us off, can you give us a bit more flavor around some of the concerns you have?
Thank you. I'll be very brief, and I have to make a disclaimer that what I'm going to say is not based on our own research, but also research of some of our partners who monitor the market. And what we've been seeing, let's say collectively, if I say we, is that the insurance-based investment products often do not deliver that value for money simply because the costs of products are too high, or also the costs of these guarantees are not transparent, are also definitely too high and not so useful to the consumers. And very often this this imbalance is obscured by the fact that there are tax incentives in the member states. So as a consumer or a user of such a product, I don't necessarily perceive it, but it effectively means that those costs are being pushed onto the public. So at the same time, it's not to doubt the usefulness of these products for some life situations where such a guarantee might come in handy, or when users are more risk averse or need some, let's say, risk investment return smoothing over their lifetime. But what this situation clearly needs to be corrected in terms of the transparency of those costs. Very often it also comes to the distribution process that is not making that transparent and clear to the consumers. Which is in many cases caused by the existence of different commissions and inducements. And so there needs to be transparency, there needs to be also clear understanding of those costs, and there is also needs to be a very well-designed suitability testing for consumers. As I mentioned before, possibility to have some simpler default products would also be useful in that respect. So that's on EBIPS. I'll stop here.
Thank you very much, Julia. Clara, maybe I'll give you an opportunity to reply.
Thank you. The debate on value for money, it seems that it's focusing a lot on the costs word and not enough on the benefits and the consumer protection. And protection has value. And for instance, you told earlier that European citizen has a lot of their savings on deposit accounts. It's because, of course, it's a low cost, but also because it is very secured. So if we take the problem from another angle, EBIPs are designed for households that are more or less risk adverse and who have limited financial literacy. And as insurers, we are able to to reduce the gap and to explain what are in this product, how the product is constructed, is built. Sorry, and we offer a professional portfolio management within a regulated framework, so also protection for the consumer. And beyond costs, value includes advice, governance, diversification. I told earlier the pro-cycle effect, protection features, and the ability to match risk and ESG profiles over time. And I agree with you. Sometimes it's not clear at all, and I believe that the advice we insurer can have a look, more closer look on how the advice is given to the customer. And you pointed out, if I may conclude with one point, one last point. In the case of Aéma Groupe, we are very proud to belong to a mutual model alignment, and the interest of the provider and the policyholders are structurally aligned. We're enforcing the focus on a long-term outcome and protection.
Thank you very much, Clara. So we have about 5 minutes left, and I have one last question for all of you. So say we meet again in 2 years. What concrete progress would convince you that the SIU is truly delivering on the objectives that you laid out at the start of the conversation? Mark, and maybe we can begin with Mark, and then we'll move down.
Yeah, I mean, I think 2 years is a bit ambitious because, I mean, what we want to see is first delivery. Delivery on all what we have triggered last year in terms of legislative process, but not only in terms of finalizing the negotiations, but in terms of implementation, effective implementation. So 2 years probably is a bit ambitious, but at least we hope that the momentum would then would be launched. Then, as I said, we want to see results in terms of financing. So we want to see by 2028, that would be great because that's our deadline for the monitoring about the first assessment of whether insurers deliver in terms of investment capacity and financing of the real economy. So we want more capital flowing into infrastructure and innovation. And then the third point, because I could not, unfortunately, discuss the pensions debate, but we also want to trigger more retirement savings and also retirement savings which deliver more value for money. And that's the whole debate which we are having right now in the context of the pan-European pension product. We want a product which is simple, accessible, and therefore which can be attractive, including for the younger generation, and can be subscribed online. So we want to see more take-up of supplementary pensions. Respectfully, we don't touch the public pensions. This is not the topic of our legislative reforms, but we want to complement the public sector, the public pensions, with strong supplementary pensions, which is a bit the same, delivers value for money. I would have liked to talk about guarantees, but unfortunately I don't have time, so I will leave it for next time.
Thanks, Mark. Lucio.
Many thanks. The true year is a tough one. I started my day in a meeting about financing for the defense sector, and I had a representative of Ukraine that said the turnover time between order and delivery in some cases is 2 days, right? So this beats anything that we can do out of the water. What can we do in 2 years? I think that one thing that would clearly indicate that we are serious about creating a fully integrated financial market, and the 2 years is credible for that, is for us to finally have a euro area-wide bank. We are here 20 years after the creation of the euro area. We don't have one single euro area bank, and that's not because of legislation at the European Union level, not our fault, fellas, right? But because of the member states, right? So if this were to get off the ground, that would be a great indication of this. Allow me one small point on the pensions, and not only because the PEPs, that is this legend that was created on my old office in the Berlaymont, the original design of it, never get off of the ground. We really have to do it for a very simple reason, for the well-being of our citizens. You ask and that's a story that Sean always tells me, Sean Berrigan, your boss, right? You ask a Irish truck driver how much he thinks that his salary and is going to be replaced by pensions when he goes into retirement. And the guy tells you 60 to 7%. The real figure is 20%, right? And that's because the level of return that we have on all the pillars that we have for our pensions is actually extremely low. Now, the moment that you realize that, you realize as somebody that will go into retirement at some point, even with my European Commission pension, I should point out, that there is a huge gap between what we need and what we are going to be needing. The only way that you can overcome this gap is to greater returns, and the way that this is done is via allowing your pensions to be invested on markets and to have greater returns. If we have even a little more of our pensions creating those pools of capital and therefore generating greater returns to our citizens when they go into retirement, that will be an indication that we are on the right way in terms of finally created integrated capital markets in the EU.
Thank you. Julia?
If I may, I will have 3 wishes or 3 points. So first point, I will agree with the 2 previous panelists. I join into those wishes. I also very much agree that probably in 2 years, I'm happy if we still continue with this agenda and stop doing start and stop. Second point on pensions, I think it's great that if people had those opportunities to invest, which taking one step back presupposes that people will have something to save onto those pensions, right? And this is not very implicit with the aging population. And if we don't get the European economy going and don't get those productive investments, I doubt that people will even have something to invest in. I think that's a very big discussion, right? It's great to have Pillar 3, but if people have nothing to put onto that Pillar 3, that becomes a bit more problematic. And the third point that I was not even expecting that we will speak about so much, but like listening to the previous discussions around securitizations and everything that might come with the banking competitiveness package that we also just published a paper today about. I think I have a very big wish that we don't have a crisis in 2 years because, yes, well, hopefully. And I think that that is the biggest concern because we see that clearly the pendulum is now swinging in the other direction. There are some small things here and there, a little bit securitizations, a little bit NBFI, a little bit capital requirements relaxation, huge debate around competitiveness, even though actually I might disagree with you that European GSIPs, so the biggest European banks, have actually higher capital requirements than their US counterparts. So I think we can discuss about simplifying the capital stack, and that I very much agree with, but without reducing the requirements, just because...
Why don't we put them at 100%?
No. I mean, I'm not saying we should be increasing them. I'm saying we should really reflect also on the level of risks that we have today compared to 15 years ago when that framework was negotiated, right? But there is a lot of technical detail into that, so I'll stop here. Thank you.
Thanks, Julia. And Clara, maybe to close off the panel.
Thank you. I understood the question slightly differently than the other panelists. So I understood the question as what proof can we see to what is the proof that we are on track to success for the SIU strategy? And I will have something that came in mind very quickly is regarding today the proportion of investments for European citizens today, European citizens invest a lot abroad, and especially in the US, regarding the asset management, the low cost theirs over there. And I think one proof could be the increase of proportion of investment of European citizens in European assets instead of the US. Because today, when we see that the US investments are more effective and the performance is better. So it's always the question of which one of the egg over the chicken. But I think we will see an improvement, and we will see that we are going to succeed when we'll see this shift in investments in European assets. Thank you very much.
Thank you, and please join me in thanking all our panelists for the great discussion today. Thank you.
Thank you, everybody. I'd like to say thank you to Aéma for, first of all, setting up this event. I think SIU is one of those areas where, particularly as insurers, we don't get enough of the airplay that we need because of the contribution we can make. And I think that was something that came over very well at the panel that we have just been through. And thank you also for the wonderful Petit Four and coffee. That was fantastic. Excuse me. So I will be moderating this second and final panel. And I hope for all your sakes that the moderation is such that you hear very little from me from after I've done this particular introduction. So on this panel, we're going to be taking the next steps in SIU. We're going to be looking at, having heard of the infrastructure, if you like, what we're going to be looking at is what components do we really need to achieve the SIU objectives? And to this, we've got a fantastic panel, some of whom I've met before and some of whom I haven't, until Aéma very kindly invited me to moderate this. So if I could welcome to the stage Elisa Rolla from the European Commission, Alexandra Palinska, who comes to us from Eurosif, Dendo Aéma, who is from Aéma Group, and Laurent Newell, who is from Ferma. I'm going to give a brief introduction to everybody just because I just want you to know the backgrounds. What we've got here is a really fantastically diverse group of expertise, and I think it's worthwhile you knowing what that expertise is so you can understand exactly the perspectives and also the basis for the discussion. So if I start with Dendo. Dendo is the head of responsible investment policy at Aéma, has previously been with the Fonds de Garantie des Victimes. My apologies for my appalling French accent. I will blame that on a bad education. She's been at the Caisse des Dépôts et Consignations, is a lecturer in sustainable finance at the Leonardo da Vinci School of Management in Paris, has an MBA in CSR and organizational performance from the Institut Leonardo da Vinci. Laurent Newell, at the end, is the CEO of Ferma, the Federation of European Risk Management Associations. So that's an association, a European association of national associations representing essentially the risk managers and insurance buyers from all the major EU member states. Laurent himself has a background as a risk manager and was with ArcelorMittal, has also been in reinsurance. Some of us have also been in reinsurance, but we keep that quiet most of the time and don't put it in our CVs. Enterprise risk management, risk financing, and underwriting. So somebody who has a real view of insurance from the perspective of having practiced it, having bought it, and having been looking at the risk aspects, which is something which is dear to a lot of our hearts here. Alexandra is the director, or the executive director, I should say, of Eurosif, which is the European Sustainable Investment Forum, which promotes sustainable finance at the EU level. She comes with a strong background of EU public policy and regulation and has a particular expertise in sustainable finance, financial market regulation, company law, and corporate governance. Before being at Eurosif, she's been with Finance Watch, EFAMA, European Insurers, and Better Finance. So her background includes representing civil society, the asset management community, public listed companies, and individual investors. So again, we've got a profound knowledge of this whole panoply of the different constituents within a certain area. And then Elisa, last but definitely not least, she's the Director for Prosperity and Competitiveness in the Secretariat General of the European Commission. Previously, she was head of unit at the Recover Task Force in the Secretary General of the European Commission and has been head of a number of units. This includes for the Common Fisheries Policy and Structural Policy Development and Economic Analysis and the Directorate General for Maritime Affairs and Fisheries. Before joining the Commission in 2003, she was a lecturer in European politics in the Department of Government at University of Manchester and holds a PhD from the LSE. So I think you can see that we've got just so much knowledge, so much depth of experience. So I will move on, and that hopefully will be almost the last you hear of me, except for posing some questions. So we will put this into a few different points or areas as we had in the previous panel. And the first one is we want to look at this broad landscape now of competitiveness and simplification. Simplification, important word. So Elisa, if I could turn to you first. Could you please put the SIU for us into this broader agenda of competitiveness and simplification, how it fits in with the agenda, how far it's gone to date, and how is the equilibrium itself established and managed between deregulation on the one hand, some would call it simplification, others call it deregulation, interesting sort of nuance there, and also the requirement for a stable environment and an ongoing long-term stability in a way that becomes reliable. If I could hand over to you, please.
Thank you very much, Sarah, and also many thanks for inviting me today. I have to say, I'm not an expert, absolutely not, and certainly this is not my field. But what I am is, my role in the Secretariat General is to bring all of these things together. So in the work that we do in the Secretariat General, so we work directly for the President, and the work that we do on competitiveness and prosperity, it's about bringing industry, single market, financial services, taxation, energy, so everything to do with a direct contribution to the competitiveness agenda together. So I think the fact that I'm here today, for me, what is important is also giving that signal that the contribution of the world of insurers is essential, and we heard it in the previous panel, for both the investment in the real economy and for the completion of the SIU. And I really like the intervention of my colleague Mark in the previous panel from DG FISMA, and I'm actually not going to say very many different things from him, but perhaps our starting point in all of this is the wake-up call that we got. I don't think we got it. I think we understood it already for a long time, but the Draghi and Letta and Noyer reports, which really put, I think, a perspective on things. And I don't want to rehash what was in the reports, but it clearly showed that we had a lot of work to do. And the Savings and Investments Union action plan was, I think, a first step in the right direction. More recently, in fact, this week it's being discussed with the member states, and next week with the Parliament, our One Europe, One Market roadmap, in which we basically say for a number of key Savings and Investment Union files, such as the securitization, market supervision and integration, pensions, and the upcoming also report on banking, as well as the targeted amendments to banking. We actually set a timeline. In the roadmap, we say we want this all completed, the first 3 by the end of this year, and the other 2, on the banking by the end of next year. So we really want to put, with this One Europe, One Market roadmap, not pressure, but give a signal to the co-legislators that we need this done quickly, because there is an urgency to it. So I think if there's one message that I'd like to pass here on the competitiveness agenda, and the role that we want you to play, it's the urgency. Then on simplification, simplification has been a very interesting ride. If we look back at all the omnibuses that we came forward with last year, I think we have always been very ambitious, but the form and the pace has evolved a little bit over time. So if you remember, the very first omnibus package tried to tackle the sustainable finance, the due diligence, the taxonomy. And in a way, we were a bit of a victim of our own ambition there, in the sense that I think we didn't quite anticipate the strong reaction it would get with a lot of stakeholders. And I think it was we learned some lessons from it. And so if you look at the successive omnibus or simplification efforts that we have done, they have been much more targeted, much more nuanced. And we have really tried to take the message across that, you know, simplification does not mean deregulation. This is about, you know, still keeping to our policy objectives, whether it's on sustainable finance, whether it's on the clean transition, whether it's on environmental legislation. But we were able with, for example, the CSRD, reduce the number of reporting companies by 85%. Under the taxonomy, the simplified reporting led to a reduction of data points by almost 70%. So I think those are just some examples of where we have tried to use simplification to try to, in a way, alleviate the burden, whether it's reporting or administrative or whatnot, on companies. And Mark gave the perfect example of the Solvency II, and how this review is really meant also to help leverage the investment in the real economy. But I think the proof is in the pudding, and I think we need to see whether or not our simplification efforts will translate into that investment. Because, you know, whenever you talk to industry, whenever you talk to the, you know, financial institutions, they all say, oh, we need simplification, we need simplification, we need to, you know, capital requirements, et cetera, et cetera. But then it doesn't always translate into those investments in the real economy and investments here in Europe. You know, and that's, I think, why we need to be prudent with the pace that we're going. We need to look, and that's why I think Mark's point on the review will be, and the monitoring that we're going to do is going to be very, very crucial. Because if that investment is not arriving, then there's something else, then there's another issue there that we need to do, and it may not necessarily be with the complexity of the regulatory frameworks, the requirements that have been introduced. So I think that's an important point.
Thank you, Elisa. I think there's a lot that people may want to have questions about in a bit, but I think we should move on with the views of the panel and maybe go into questions a bit later on if we have the time. So Dendo, if I could turn to you now, please. Now, we've heard a bit about this already, but you're there right at the front of it. The role of insurers as investors within the broader competitiveness agenda, I think, is something we really need to look at. That whole business about financial performance, again, having the balance with the resilience that's needed. Are there specific risks that have been identified in the, let's call it, simplification agenda at this point in time?
Can you hear me? Yeah. Thank you for the question, Sarah. Firstly, as you know, we are a mutualist, an insurer. So we have a philosophy, long-term vision and long-term philosophy. We prioritize the protection, stability, and the interest of our policy holders over short-term profitability. And that is a very interesting point for us because it's in our DNA. And we have to protect the saving entrusted to us by the citizen and the savers against climate risk, and to mobilize these savings to finance green and social transition. So to do this, we need the regulation to enable to have strong, robust ESG data. And regarding the competitiveness, as a long-term investors, we have a diversified portfolio to meet our long-term requirement. So for us, competitiveness is linked to resilience. Investing the savings entrusted to us to in companies that is highly competitive today, but does not manage its climate risk exposure, exposes the savers to a financial risk because this company may default. So that's a very important point for us because we are long-term investors.
So do you feel in that then that it's possible and viable and executable to be able to get that balance, that stability? Is that something that is not just a target, but something which is achievable at this point in time?
I think it's achievable, but we have a lot to do. We have to take care of the simplification because the simplification of the CSRD, the SFDR taxonomy can hinder the achievement of this goal. As I said, we need synergy between CSRD, SFDR and the different regulation.
I think that's a very important point, that in fact we've got a lot of change happening, but it needs to be aligned, because a misalignment in this actually creates so many, it's the ripple effect, the stone that goes into the pond, and it just keeps on going further and further out into all sorts of places. Thank you. So if I could now turn to the next area we want to discuss on these potential obstacles. So here, if we can look at some of the growing risks and also the lack of integration of this. And Laurent, you are our risk person here. I think that when we started talking about this, we hadn't any idea that the geopolitical was going to get even more challenging than it is now. But we're looking at climate, we're looking at the cyber threats. And risk management seems to be an essential element of the stability and predictability agenda as it comes on at both the global, the individual country economic level, and also for the individual themselves. What then, looking at this incredible vista that we have of challenging risks, what then do you see as being the role of risk management when it comes down to the actual completion of the SIU itself?
So I believe I'm going to go, down to earth in terms of risk management, and I would like to quote, Mr. Vinícius de Souza. I hope I pronounce it correctly. When you talked earlier about supply and demand, and also what you said about, there is a policy, there is a framework, but then that money has to flow and be invested. So we need users, and if I think about risk managers in companies, that's really what we need from our side also to improve, because there are indeed significant needs for investment if we look about the future, also in risk management and prevention measures. And today, there is a missing gap. If you think about what is the job of a risk manager, it's pretty simple. It's so simple that everybody believes that they can be a risk manager. But basically, first, you have to identify. First, you have to understand your business. Two, you have to identify your risk. Then you have to assess exposure, probability. Then you can prioritize them. Then you can work on mitigation, which is prevention, whatever. And then you have a residual risk, and you have to finance the consequences. And you do that. The best known product is insurance. So companies buy insurance, but there are plenty of others for financing the consequences. And if you look at the role of risk manager, and if I connect that to the SIU, when you have an issue right now is when you are in the mitigation part and you need capital-intensive measures, it's really difficult for these measures to for capital to be allocated. So we always say we don't have a risk management problem in terms of risk assessment. We have a capital allocation problem because we are not really able today to translate risk and exposure into financial metric and into an investment decision. So taking a very simplistic example, if I have an industrial facility and I have a flood risk, I identify it, I make, a calculation, I say my exposure is 500 million, and I go to my CFO and I say we can build a wall around the facility and the exposure becomes 20 million and the wall costs 10 million. But my 500 is full of assumptions. The various model can give different numbers. My reduction in exposure is full of assumptions, and I can have different, estimate for that. And then it's based on a narrative. I cannot talk to the CFO by saying, like you do when you go to a capex, decision maker. You go and you say, this is investment. When it's about productivity or growth, it's easy. Of course, you make assumption, but you say, I'm asking for X. I'm building up a new production line. Additional EBITDA will be Y. It's over 10 years. You calculate the NPV of everything right now. Bang, this is your return. And then all these capex projects are competing against each other. If you go into a company, they have maybe 150 projects and 50 are going because the envelope is not unlimited. And what a capex department does is they look at this from a rational perspective. What is, and of course in line with the strategy of the company. If my strategy is to grow, if my strategy is to improve productivity. So for prevention measures, it's really difficult because you come with something for which the metrics are not really, meeting the requirements. So, then you have people saying, yeah, but you can convince your CFO. Absolutely, you can convince him, but I always say it's based on a narrative. So you can scare him, but it's still a story, okay? We have a flood exposure, we have a calculation. But then you have your colleague coming from a growth investment, and it's factual, okay, bang, 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 bang. And then you have the envelope, and he say, yeah, you're asking me to invest in something, the exposure is 10, 15 years' time. The return is difficult to calculate, the exposure is not really objective. So how do I make that decision? And usually another project is selected. So that's really something where, if I look at the risk managers, that's, I believe, our duty to work on this, to really try to fill that gap and find a way, and maybe we can come back to that later, about how do we, I would say, raise the role of the risk manager in terms of becoming actionable and being able to help companies to make that decision more easily, more in line with the financial framework of the company, to be sure that if we talk about climate change, we all know frequency and severity is supposed to increase. What about the adaptation measure? What about the prevention measures? That's something that will have to come. But today there is a work to be done in the risk management community about how do we transform risk awareness into capital allocation decisions.
Yeah, because you are essentially, a lot of the time, you're the bridge into two different perspectives of risk.
Yeah, you have... The point is you have risk which are, if we talk about mitigation, you have mitigation through, I call that through processes or controls. If you have to manage your liability risk, you can do it through, through contract. But once you go to the physical risk and the investment, which require, physical investment, you have to put a sprinkler in the facility. You have to build, as I said, a wall. You have to put, sheet piles to protect from the flood. Of course, you need to be able to. The risk is understood. The CFO is not saying, yeah, sometimes you have that. They are telling you, it never happened. But they understand it. They are not. But the point is, for making an investment decision, something is missing in the process. And that's really something where I believe we as a risk management community, we have a role to play to create that user part, that these projects can compete with other investment projects on the same basis. We used to say that adaptation prevention becomes investable when it can be compared to other investment. And today that's something we see is a bit lacking.
Yeah, I think you've identified something that's been seen as being a big challenge for a long time now. insurers want to be involved, but it's how to be able to as investors. So thank you for that. Elisa, if I could come back to you now. Apart from this area of risk, what else do you see are the remaining obstacles to the SIU at the moment? And do we have any fragmentation issues, for example, that have been identified at the Commission or that need to be addressed somewhere along the line?
I think on SIU, I think the action plan pretty much lays out what we want to achieve and the level of ambition that we want. However, I think there are other enabling, and there's another part of the regulatory framework which will also help the SIU, and let me give you a couple of examples. We came out a few weeks ago with the proposal for the 28th regime, and I think that will also be a very fundamental piece, not just for the single market, but we see this also as important for helping facilitate the movement of capital and address the fragmentation. So the EU Inc. Proposal. We will also, we've committed to reviewing the shareholders' rights directive, which we also think will very much help, balancing rights of shareholders and the need for companies to maintain sustainable governance and control. So that's also something that we think will help companies. One of the things that colleagues are working on is the review of the venture capital and private equity rules. So there's a new strategy which will be coming in the autumn. And here the idea is to facilitate access to alternative capital pools to connect our investors, the demand side, more easily with fund managers and investments in the supply side. And I think all of these things can work very much with the buy-in of the insurance sector. So it's not just. I think what we're looking at is, as part of the SIU and the related proposals, is for the insurance companies not just to play their traditional role of risk insurance, but really, go into that, take up the ambition and the risk of being a more strategic investor. So these are some of the things that we're trying to do to facilitate that and to make the regulatory framework and the environment more conducive to those to that type of switch.
Thank you. Again, I know time is not necessarily on our side. We've got a few minutes left, though, so I want to move on to the next area that we want to address here, which is the enabling environment, basically the role of sustainable finance and risk management. And Alexandra, if I could pass to you first. There have been thoughts that simplifications could actually weaken our leadership in sustainable finance. Is this true? And if so, what are the implications? Simple question.
Thank you very much. And the answer is also very simple, yes.
Could I just check the mic on?
Let's see. Yeah, you can hear me. So yes, the answer would be also quite simple, meaning yes. I think, as the EU, I think we have done quite a lot in terms of I would say leadership on sustainable finance across the world. In reality, if we really want to take a step back, I think we should remember that sustainability reporting started in Europe. ISB developed it because they wanted to catch up with us, okay? And maybe sometimes it has been also misused by certain lobbyists to try to actually override what we've been doing here, which we should keep in mind now in the last days of, I would say, here decisions on European sustainability reporting standards, which, if I may, actually they have been simplified and reduced much more than by 70%, because there have been several batches of simplifications. And I have been sitting on the EFRAG Sustainability Reporting Board myself for a while, and I have witnessed many different, I would say, stages of the simplification. And what is even worse, after the last simplification, which not only reduced, by 70% the standards, but also let's not forget that the scope of corporate sustainability reporting has been reduced by 90%. So we should look at the cumulative, I would say, aspect of that. Now there are, I would say, strong lobbying, efforts to even change that further, going maybe even potentially as far as trying to make changes which would result in weakening the double materiality assessment. So honestly, this is like very significantly concerning, and actually maybe even going back to, I would say, some of the themes of this conference here today. Let's talk about sovereignty and autonomy. I'm sorry, is this what is happening, allowing certain, I would say, groups and forces from US and other parts of the world dictate us what we do in Europe? Is that really what we want in terms of competitiveness, sovereignty, and autonomy? Another question, what we have recently once again witnessed with soaring fuel prices, which basically undermine our weakness, our over-dependence on, Russian gas, the oil from Middle East, on US or whatever else. Like, I'm sorry, what is this? Like, exactly, the countries like Denmark that have already 30 years ago significantly invested in renewables, they're so much more resilient, right? Because they are so much less dependent. So actually, sustainable finance, this is not, I would say, it is not at all undermining our competitiveness. Sustainable finance and proper integration of ESG considerations into capital markets, actually this is the prerequisite of our competitiveness, sovereignty, and autonomy in the future. And what is happening right now in terms of the simplification, I guess we could discuss file by file, because in some cases it's more, I would say, severe than in others. But what has happened with Omnibus 1 on, I would say, targeting, well, the corporate sustainability reporting, but also targeting corporate sustainability due diligence directive, removing an obligation for companies to set and implement climate transition plans and targets. Like, at the end of the day, with this, I'm sorry, this is deregulation. Because, of course, I think we could all agree that a thoughtful simplification, removing duplications, I would say making rules usable, that is fine, and we're very supportive of that. But the problem is that I would say this agenda has been misused to actually, have an outright regulation. And I would ask another question. There are so many things in the EU law and EU processes overall that could be so easily simplified, even access to funding, right? I mean, which is so burdensome. Look, we have market abuse rules which are super complicated and not very effective. We have prospectus rules that could be simplified. We have so many different rules. My question is, why Omnibus, the first Omnibus, has targeted sustainable finance? Why? And was this the good choice? Because if we look at the big picture, maybe not so much. And maybe the last point, like, yes, sustainability disclosure, somebody could say like, oh yes, this is reporting, this is burdensome, yes, but without data, how can we invest? Otherwise, like, exactly, you as insurers, right? And investors, exactly, to close the funding gap and everything, also like even retail investors, in order to make informed decision making, they need the data. Without the data, we're going blindly. We don't know what is happening. And risk management, this is central to risk management. In reality, sustainable finance, this is risk management 2.0. This is actually a risk management tool. Like, so many, like in California, I mean, insurers, they no longer want to insure, right? So the thing is like, how can we talk about anything without really the data, robust data? So yes, I think, all of that is essential, and I guess we could discuss, for hours. But yes, I think there is really a danger to EU losing our leadership on this. And, let's not forget, and I think, one little actually light of hope I see is that in many jurisdictions, like, for for instance, Central and South America. Like, look, if you look at Brazil, and I would say so many countries actually in this region, they already started actually applying taxonomy. And they went even further. They've developed a social taxonomy, which is amazing. So we have inspired so many jurisdictions, and I think we just have to, try to regain our leadership and strong position there. And I'll maybe conclude on a kind of a positive, I would say, point, sharing a little bit of insider information. So being now a part of the platform on sustainable finance, I attended a working group session during which it was reported that in 2025, we have reached a mark of 1 trillion of investments in CapEx, actually taxonomy-aligned CapEx. So these are investments, 1 trillion. This is huge. And the only sad part is that now with the reduced scope of corporate sustainability reporting directive, I think maybe less companies will be reporting that. But this is just to show that, yes, it took years for taxonomy to start working, but we are there. Also, EU Green Bond Standard is doing amazingly well. So I think we should just, stay the course.
Thank you. I love the passion as well on something that is so incredibly challenging. Laurent, if I could just turn to you, coming back to, if you like, the physical protection elements, what do you see as being the sort of incentives that will make prevention investable, following on from what you were saying before?
So if looking at if I look at risk managers' perspective, and maybe just a slight comment about insurance companies and their role in the SIU, we like insurance companies for 2 main reasons, and we want them to be healthy to deploy capacity, because we want to be able to cover our risk through insurance, and so they need a healthy capital and be able to deploy capacity, especially if we think about nat cat, climate change, and so on. And 2, we would like to look at them also as as that's a topic for today, as investors, in this measure, because we also see that for them, as I always call that the double kiss cool effect, in that if insurance companies, they are huge investors, if they can invest, for instance, in we talk about resilient economy, and we talk about adaptation measures, into these projects over long term, they also reduce by the end the level of claims they will be exposed to. We were looking at the what we call the funding challenges around this, and we saw 4 main angles. The first one was, how do we fund the insurance gap? And we talk about private public partnership, the PPPs, and so someone has to pay. But why are these risks not insured? That's also a question. But how are we going to finance that in the future? 2, how do we make sure that the reinsurance and insurance market is capable of offering capacity for insuring natural catastrophe? And I always prefer to say climate risk, because it's not necessarily a catastrophe. And that's about how do you deploy capital into the insurance market, how do they balance the portfolio, and how do they work from keeping that capacity affordable, because, for insurance companies, it's always easy, you just have to balance premiums and claims and your cost, and you have a portfolio and make a margin of profit. And that's how it goes. So there is no miracle if there are more claims, more frequency, more severity. In insurance, and if you look at risk management, you only have 2 ways of managing this: is increasing premium or reducing claims. You have to balance this in a way or the other. And we believe that adaptation, which is the 3rd one in this funding challenge, is something working on this, where they should also be interested. And just for the anecdote, the 4th one is what we call decarbonization and energy transition. This is also where you need funding to allow that. So if I'm back to the adaptation measure, I believe the incentive is first, to work on the missing gap I was talking about. So I believe we are at Firma going to launch a project, so it's going live in 2-3 weeks. So you will allow me not to mention everything, but basically we are gathering partners like insurance companies, brokers, businesses, industrial companies, to really work on that framework. What we were talking about. First, how do you have a credible and objective exposure assessment for that decision making in finance? Two, how do you have an objective and agreed assessment of the reduction in exposure thanks to the mitigation measures? Three, how do you develop a system to translate that into financial metrics for a CFO to make a decision to invest? And four, how do you create attractiveness in the financial market for this investment to come? And it could come to incentive through, we can think about lower capital charge, for investors doing this. And we believe that's a project we really want to address in the next 12, 14 months, for hopefully creating this, or at least launching a debate to help, back to what I was saying about creating a bunch of users ready to use this investment. Because in terms of adaptation, once again, we believe from the risk management perspective, decarbonization, it's of course a risk management process, but it's a risk management process at society level, but a risk manager, once again, back to Earth in his daily job, he looks at the risk and he said, decarbonization. I have the risk of the decarbonization project, but that's not really my core topic. But adaptation, transition, to protect the assets and the company to be more resilient over the long run is really a risk management duty that we believe should be developed. And that's really what we intend to do. And then we will try to connect with regulatory bodies and to see, in terms of incentive and the financial market, how we can create that framework to really help. Our point is always to try to develop best practices and tools for risk managers to be more relevant for their company and have more of an impact. And for that topic, we believe that's really where we need to make a difference, to really help them to move, because we see, the time horizon sometimes looks pretty far away. You were talking about the geopolitical tension. We also see that in companies, it also sometimes now slow down these projects because the urgency is next week, next month. And then what will happen? And then you have the energy price going up and all these things. So we really believe in creating a framework which would help to, let's say, institutionalize that process, having a structured process that will help all these projects to make sure our businesses in Europe are more prepared and adapted, I would say, to climate change risk, which should unfortunately increase in frequency and severity in the next decade or so.
Yeah, I suppose unfortunately one of the positives is at least every CFO has got their own personal exposure to this climate change as well as the commercial exposure. So that helps with risk awareness because you're starting at that level, but it's still, we'd still see that in certain aspects the risk awareness dimension is one which is still needs to have some work done on it. So it's very interesting to hear of this project, and we'll be looking out for more in the next 2 to 3 weeks and take it on from there. Thank you.
You're welcome.
Thank you. So our final area that we want to talk about briefly, because we are, as I said before, short on time, but we're now even shorter on time, but it has been talked about before, is the whole area of shareholder rights. And if I could turn to you first, Dendo, we heard about the potential changes to the directive, and where there is this dimension of converting the caution of European investors into an investment community rather than the savings community, and therefore freeing up that view. But there is a psychological change in that. And part of that psychological change presumably can be surmounted by the investors themselves knowing where their money goes to. But is this really sort of like reflected then on shareholder democracy and whether that actually becomes a long-term strategic investment dimension, or whether what we're looking at is something which needs a lot more work to it before it becomes viable and valid?
Yeah. We think shareholders must have the right to question companies about their sustainable development strategy, because sustainability is a systematic risk. Yeah. If it is materialized, it could have a very significant financial impact. So investors should have the right to know whether the company they wish to invest has implemented a social or environmental transition strategy. That's really important.
And when it comes down to it, what are the barriers that we see at the moment then to that being a possibility? What are the big challenges currently?
Maybe the big challenge is the fact that is the fragmentation of the national rules that govern this exercise. For example, the ownership threshold or the procedural requirement. This could make a very complex environment for shareholders' rights.
Thank you. And Alexandra, if I could pass to you on exactly the same subject.
Sure, with pleasure. So yes, indeed, Shareholder Rights Directive is also quite an important piece of legislation. And indeed, one of the very important tools that shareholders have at their disposal is the engagement with companies. But indeed, as Dendo said, I think it's still kind of, I would say their rights are often impeded, especially in the international context. So, for instance, something that indeed now the Commission has already addressed in its ongoing and soon closing consultation, there is a long range of questions connected to the plumbing issues, so the intermediary chain, which indeed is very complex, very often antiquated, and already was during the former review. And but it's true that, you know, especially now with AI and, you know, so much, you know, so many technological advancements, we hope that's going to be kind of improved. And I think the whole point is to ensure that also investors, they actually get in a timely manner all the necessary information for the annual general meetings of companies, that they can also in a timely manner send their kind of ballots and also notification of attendance, and that this is not lost, which, trust me, in international context, it does happen. So all of these things should be looked at, but at the same time, I think there are also kind of still remaining issues indeed in terms of this kind of a member state option of having a threshold of how many actually shares, like what is the percentage of the shareholding you need to own in order to put forward resolutions for the company meetings, which actually in case of companies with very dispersed share ownership, that can, you know, you really need to be quite, I would say, large shareholder in order to put forward that. So that should be either abolished or lowered. And another thing is also, for instance, rules on acting in concert. This is maybe not by itself necessarily addressed by the Shareholder Rights Directive, but it's very much connected. There are kind of Aéma guidelines connected to that. And the issue is that, you know, like many shareholders, I think especially on sustainability matters, it's quite important that shareholders can also, you know, discuss and maybe act in certain coalitions, but a lot of them are actually afraid whether they're not going to be breach of the rules on acting in concert, so that should be also revisited. And finally, you know, something that could be very helpful is to have EU stewardship code, something that also Aéma has suggested, so we're supportive of that. And yes, in terms of engagement policies, we do think it could be interesting that especially in case of sustainability-related investments, that there are like a dedicated section of these policies or even dedicated actually sustainability engagement policies whereby investors also explain, you know, how they actually engage with those companies. And the last point, quick, I promise. There is one teeny tiny ESG provision in the current directive which was already watered down, and we have to maintain it and maybe strengthen it, is actually transparency of directors' remuneration and the links with ESG goals. So that is a very important one. And look, the point is, like, in any case, it's not prescribing anything, it's just transparency. But especially if the company has ESG goals, isn't it normal that directors' remuneration should be aligned?
Okay, just therefore, I just want to do one sentence from everybody. as our closing round. The question, I'll start with you, Laurent, if I may, which is 5 years from now, what will tell us that we were successful? Just one sentence answer.
Jesus.
Jesus, that is the answer.
It might help.
Yeah, no, I mean, from my perspective, I believe if we have that, SIU project, being successful, and looking at our side of the spectrum, if we are able to move what we need to do, I also believe I like the idea of, that supply and demand, and we need users. I also believe businesses and then risk managers, that's what we are, have also to do their homework. So for me, I would say we would be successful if we both succeed in parallel for meeting at the point where it's then efficient for financing these risk and of course all the other measures. But as risk manager, we are looking at risk and adaptation and prevention to support our companies to be resilient in the future.
Thank you. I'm loving that spirit of cooperation. Lisa, if I could turn to you, please.
I'm going to abuse the question. I'm going to say 2 sentences. One is what I'd like to see in the short term, and one what I'd like to see in the long term. In the short term, and I want to go back to what Laurent was saying about the risk, the climate resilience is super important. The floods, the droughts, the fires, 25%, less than 25% are insured. We need the insurance sector to step up for the long-term challenges. And I should also say we had the VTC video conference this morning of transport ministers on for the Strait of Hormuz. Please help sort out the maritime shipping. They're in trouble, so please help. So maybe a little plea from the transport side. That's the short-term priorities, absolutely nothing to do with the subject. In the long term, 1 sentence. If Europe wants to assert itself as a strong economy in a fragmented world, we need an SIU which will allow institutional investors like the insurance sector to invest long-term, safely, soundly, confidently in green digital transition. So in an ever-competitive world, 1 sentence.
Thank you. Thank you. Dendo, if I could turn to you, please.
Maybe the fact that the SEU allows investors to protect the savings against climate risk and in a resilient and competitive economy.
Thank you. And Alexandra, the last word to you.
Thank you. I wish for 2 things. A, that the capital flows consistently and, in much higher amounts to sustainable, future-proof, resilient investments, and that we stop talking about sustainability because it becomes so integrated and such a normal thing that we will not need to single it out anymore.
Lovely. Thank you very much. If you could all join me in thanking our panelists today. Thank you. And if I could hand back to our hosts, please.
First of all, let me wholeheartedly thank our 2 panels, excellent panels and discussions, and then, of course, the organizers plus you, the audience. I would like to give a couple of, first, my personal impressions, and then a couple of words for the future. Firstly, no, the sustainable finance package was not even close to be ambitious. It was not even the 1/3. It lacked the resource efficiency, it lacked all the planetary boundaries, the biodiversity, and the social dimension. But at the same time, I feel for the Commission and Commission's civil servant, because sometimes you need to explain the mess what the politicians create, and try to explain why it is a good idea to put the kettle on the freezer when you try to boil the eggs. this is the competitiveness and sustainability. So I'm not putting the blame on you, I'm putting it on us, on politicians for doing it. And what I hate really at the moment is how much pressure nowadays, it's always been there, but nowadays comes from the politics towards the Commission. There's not clear enough firewall there, and the independence that is in our treaties also in Commission to think, to prepare and present, and then we politicians battle over that. Then the second point is about the risk assessment. I think it is very important, and then it boils down to the same fact. What you need the data, you need the sustainability reporting. Actually, it should be an accounting directive, an audit directive, to make it simple. And beside that, what you need the do no significant harm principle throughout the regulation. And what you need the regulation, because there's the issue what you, Laurent, very beautifully described. How do you sell this to the CEO and to the board to put one hell of a money to that kind of an investment? There, regulation. You need to be taking the climate and other sustainability issue as a part of the risk assessment. And if you don't, none of the investors should be able to insure it. But not on the today, because that would be counterproductive. But let's say, okay, this is coming after 5 or 10 years. And then it is on place, and if you haven't put your house in order, the banking lending would be impossible, or much higher risk rates, and you wouldn't get insurance. That would speed it up significantly. Okay, this is one thing, and the last comment from my personal side is that there are two ways that I wish this community would take. The first one is to lobby. Nowadays the politics is very much about the noise. I hate it, but let's be frank, this is what it is, and it is reflected in the European Parliament, in our national parliaments, in our national politics. And guess who is making the noise? It's the MAGA European version. And if you guys do not make the noise, this is one-sided message that we all are getting in politics. Do not do. 2 out, 1 in. Over-regulation. We are good in regulating and bad in competing and all that story that we hear day in, day out. Well, if the regulation is so bad, let's abolish property rights. Why do we regulate? Do you ride on right or left side on the street? Everybody can choose what they want. That increases the competition, certainly. The regulation makes the predictability, it makes the level playing field, and it gives the long-term perspective. And basically we wouldn't have any business at all if we wouldn't have a proper regulation. Then we can go on details like with the reporting standards and how many and what is simplified version for SMEs or whatever, and agree or disagree about the details, but not in the big picture. And I got about 5,000 emails about CSAM regulation, nothing to do with the sustainability, but child misuse. And guess what? It was overrun. It was overrun because 5,000 people contacted at least me and the other members of the parliament and member states. It is the freedom of the internet. No, you can't check. After police and court orders, you can check what happens in the dark web, for example. Everybody knows it's not going to happen that way. You need the different kind of actions. And then about the sustainable finance, indeed. I got a very nice email from Global Compact with very cordial language telling this is not a very good idea. Actually, it's a pretty bad idea that you are throwing the baby and saving the bathing water. That actually happened with this proposal that came by the Commission after very interesting moves. And it was endorsed, undersigned by 1,500 CEOs. It was just one email. Imagine if 1,500 CEOs would have sent a letter to Commission and to parliamentarians telling this is a bad idea and this is bad for our business. It would be a totally different thing. But we get the other side, but not the other side. So please express your opinions, not only as companies, but as individuals and specialists and whoever you are, because we need to defend Europe that is capable, that is looking forward, and that is delivering. And yes, we can do, I'm pretty sure, because still 70% or more than 70% of the people are very much on the same side with little of a differences. So why do we let the other small parts of the rule the whole game? Well, this was my personal sustainability comments. And then about thanking two very good panels discussing about the sustainability, the latter one and the first one. What is the role of insurance and mutuals in our savings and investment union? And this is the thing that I hope that after this discussion you could address politicians, MEPs, and hopefully we could get there a clear avenue that yes, we can leverage the risk, provided it is for the Green Deal, for the sustainability, combating climate change, not having significant harm in the investments, and that is the long term. And I think it is very good comments about, for example, how long term this kind of a life insurance investment should stick, and that the investors, retail investors, should know about that in the first crisis, be it personal or global, you wouldn't in quite many cases be able to draw all of your assets out, because this is actually what we need. We need the stabilizing factors in our financial markets and many other points. So this was very fruitful. I take this as a start for good cooperation, discussion, and I hope I'll be in contact with all of you, and we'll sort of keep the ball rolling and make the savings and investment union really what it is supposed to be. So thank you all.
It's very hard to take the mic just after you, dear MEP Pietikäinen. So just a few words to thank you all for your presence today. It was very inspiring, if I may say so, the two panels and all of you here. Well, we were quite a coalition of the willing today. A coalition of the willing, of course, to promote the role of insurance, but not the technical, classical insurance. We've shared, I believe, a conviction that it is good that Europeans find good protection to European insurance providers, and in the same way that the European economy is invested by European insurers and asset managers. In a way, the belief we have shared during all the afternoon is that insurance is not only a matter of protection, it's a sector of sovereignty, of prime importance for all Europe. And hearing all of you, and thank you all again for all you said, I allowed myself a dream, because yes, insurers have dreams. Very reasonable dreams. So I had 4 dreams inspired by all what I heard this afternoon. I will start with the most reasonable dream. Simplification And my vision of simplification within the EU, it's more homogeneity when it comes to investing. And today, as investors, we have difficulties, or we make choice to invest only in some countries and not in the 27 countries of Europe, because we have 27 different regulations. So a lot of cost of transactions, a lot of different risks to analyze. So the first way to go to useful simplification would be to go to more homogeneity in that. It's very simple, it's very technical. The thresholds were mentioned, for instance, for shareholder rights, but it's something that I believe a lot of our colleagues expect. The second point is where to invest, and I completely agree with Mark Horowitz. The review of Solvency II will strike its goal with the bigger promotion of long-term investment. And I would say we need to do the counterpart of this regulation. We've made the investment stuff. We have to make the counterpart on the industrial policy. We, as European investors, should have indications from Europe of the sectors or the initiatives where the money of Europeans should go. Of course, there is the rule of the market, but there should also be a connection between a financial services European policy and a European industrial policy, which seems to me one of the weak points today of the European Union. The third part of my dream, you see, it's very reasonable and very simple. It's data. It's been well said through sustainability. We are, as investors, we need data. We are, as mutualist investors, need data on sustainability. We shouldn't oppose sustainability and investment, because a good company invests and has long-term projections that include ESG aspects. And I'm sure there will be a reverse backlash one day, and we will come back to a more comprehensive aspect of CSRD, for instance, because we understand why there's been a simplification. We understand there's been a political agenda, but from a technical point of view, we only have today a partial view on all the ESG aspects through CSRD. So I'm sure in some years, through the industry, there will be back to reason on this aspect, and it's been very well said in the second panel. And for it's the dreamiest of my dream. I don't know if it's in English, but what if there was a Solvency III review? And I turn myself again to Mark Horowitz. I'm sure there will be one, because there is a Basel III, so there will be a Solvency III. So what could be the quantitative aspect, because insurers dream, but they also count. So I dream of cost of capital of investment adjusted by the climate resilience risk. I think it would be a good way to put together things that start a little bit to diverge in the agenda. We have the upcoming of climate resilience through insurance and protection that is coming, and it's very good, and of course insurers will be at the core of it. And so we will put closer again the investment side and the ESG side. I think it will be a big aspect of the coming year. So dear MEP, you call for expression. So this was a time of expression. We will reiterate it, pursue the discussion, and now let's share a good drink to pursue this discussion. Thanks a lot, everyone.